Good evening, Theo Trade. This is Corey Rosenblum, and you're watching the Theo Nightly video for the 12th of August, still in 2021, and we have another sneak attack to all-time highs. This is the S&P futures. We'll take a look at the SPX and, of course, the spiders and other markets, but we're going to focus first on the S&P. And this was made on very weak internals and very weak volume. Does that mean we're going to turn in reverse and slam to the downside? It does not mean that. But it is a concern if your perspective is bull, 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 and bull some more, which is up, 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 and bullish on the broader market. So it's not necessarily something you want to see. And what I've done on the chart here in Thinkorswim is draw a little trend line. So this is a price level. And I want to first talk about volume. And this is S&P futures volume in millions of contracts. And total volume today was less than 1 million. That is not common, but where are we in the grand scheme of things? This is just 5 years going back on the futures contract, and that's extraordinarily low volume. And outside of holiday sessions, that's holiday type tape or holiday end of year, of course, volume, if you look at it on this perspective, is correlated with down moves, just like volatility. So when the market gets heated and turned to the downside, we get an explosion of volume. And this just goes back to 2018 at the start of it, once we had a similar creeper uptrend and just new highs every day, it felt like. But that gave way to a snapback, or as I call it, a rubber band snapback. But even then, the volume was a little higher than it was right now, of course, in the S&P futures. And that led to a big explosion of volume. And that volume trailed out or tapered down until the next time the market had a fit to the downside or a pullback or a retracement. And that took us at the end of 2018. And then 2019 was, relatively speaking, a calm year. But once again, these red bars on volume correlate with down phases in the market. So you might say that during a down phase in the market, volume, like volatility, will increase. And of course, we're not looking at the VIX at the moment, but that would correlate with a spike in red volume, a spike in volatility, and of course intraday range on the rubber band snapbacks. Again, one here in May 2019, similar in August, and then the remainder of the year was continued bullish upside drift, and it did happen on reduced or low volume, and that's holiday volume over here. Well, 2020 was quite the volatile year, and we had some highs over 4 million or just into 4 million, above 3 million per day contracts in the S&P futures. That, of course, was the coronavirus, the COVID, and the shutdowns of the economy, which happened a little bit later. But once again, volume spiked to the downside, as did volatility, which reached new highs. From that point, aggregate volume has been going down to the point that we had today's volume, once again, right about here, just about 0.7 on the scale. And it's relatively low for the last couple of months, really into this June-July period. But on the grand scheme of things, that's where we are. We're essentially trading in holiday volume, just about. Now, what does that mean for the market? It's not a good sign for the bulls. If you are rampantly bullish, this is not the time to be putting on new risk, new positions, and new bullish opportunities. It is a time for defensiveness, hedging, and protection. And we're going to talk about that in a moment. And the S&P, just look at the spiders, similar type of logic and similar type of volume, and we'll go ahead and make that little gray line because we can see it a little bit easier on the screen. Not that much different than the S&P futures. Now this is the spider, SPY, and we see the volume in today's session was roughly right about 40 million. Seems like a lot of shares transacted, and it is a lot of shares transacted unless you look backwards in the spider, in which case you have volume at the moment reaching, again, holiday type levels. 2019 was relatively a smooth year, and volume did not really spike, but when it did spike, it occurred on the downside. So what we're talking about, what I'm trying to communicate, is when the market goes up on reduced volume, it's to be thought of like complacency. And when everybody gets bullish and complacently bullish, that's when the market pulls the rug, or as I like to call it, does a retracement or a rubber band snapback. Plenty of examples of that happening. But on the flip side, we're seeing the same thing where the market just drifts and drifts and drifts and drifts and then snaps back. We're seeing this happen plenty of times. I would say up to the current situation is right now, earlier in July into June, and then roughly into April, where the market was overbought, overextended, drifting to the upside on reduced volume, but it continued drifting. So again, there's no really big change in the perspective or change in the techniques or the tactics that you're using. You should be hedged or bearish or at least short-term protective when the market is extended to these levels. Keep in mind that each of these examples, particularly here and there on the chart, those are creeper moves to and through all-time highs. And the videos back then reflected that. Another all-time high, and here we are at just another all-time high. And this is not anything new or out of the ordinary. It is, to many traders, frustrating, but it is something we have seen traded through and have adapted to. And that's the situation until something changes. But just noting that volatility is low, that's seen, of course, in the VIX futures, and the VIX itself, which is today, at least at the end of the session, was under 16. It actually was 15 and 59. And we don't have volume on the VIX, but similarly, again, 2019 was a relatively calm year, even though it had spikes in the VIX. 2021 has seen similar, except the VIX has drifted down, as has volatility. Now, if you're a bull, you're too late to be bullish. Wait for the next pullback, wait for the next snapback in the market, and then you can start to establish other positions similar to these other pullbacks. And the pullback would look like this: 1, 2, 3, 4, 5, and then now we have the next phase of the market probably is some type of retracement, rubber band snapback. Regardless, it does argue for caution and protective and defensive measures. I talked about volume. The other thing we want to look at is our Market Watch. And this, for Thinkorswim users, is the Market Watch tab on the heat map, and we're just looking at the S&P 500. This is a little bit different than it was yesterday and the day before, where you had technology sector stocks, the XLK and the QQQ and the NASDAQ. They were weak. Our monsters of tech were weak. But the financial sector and the financial stocks, XLF, and to an extent the Dow and the Russell, were quite bullish. And that was sort of a split in the market. Today, as the S&P made new all-time highs, you have a similar split, but it's the opposite. And so the technology sector is recovering or bouncing when the financial sector is pulling down or retracing lower, at least in today's session. That's why you have a weak advanced decline line, and these are not numbers that a bull wants to see. In today's session, by the time the bell rang, 265 stocks in the S&P 100 were actually down or negative in the session. And you can see plenty of them here in the S&P 100. But 232 were bullish or advancing. Now that gives, roughly speaking, an equal number of volume in, volume out, and capital flow in and capital flow out. And the S&P was up a slight bit today on the concept Don has been referencing. Gamma squeeze, breakout, short squeeze, all those sort of factors has led to this S&P creeping up and attacking the market with another new high. That's at the same time the NASDAQ is not at that all-time high. And the Russell continues to trade sideways within its trading range. Now these things are not bullish kind of characteristics of a market that is making new, fresh, all-time highs, never before seen, on very weak volume, lackluster internals, and the other indices are not keeping pace. The one exception is the 30 stocks that make up the Dow and the Dow Mini Futures, and that did join the S&P to a new high. The key word here is caution. The key word here is safety, hedges, protection. Do not get too over the top bullish. But at the same time, for the bear side of the market, it is just a pullback and a snapback. Caution is always the name of the game. And before we end the video, we'll take a look at, just quickly, which stocks in the S&P made new 52-week highs, in other words, joined the market at the highs, and we won't look at them as usual, but these are not a list of really, really impulsive or big market cap names. The biggest being Johnson & Johnson, followed by Adobe and Cisco. And then we had financial stocks join into additional highs, which include Wells Fargo, Morgan Stanley, Goldman Sachs, and Capital One Financial, just to name a few of the 45 stocks. This is not the first time we've seen an all-time high. This is not the first time we've seen bullish upward drift or gamma squeeze, if you prefer that term, or just a short squeeze continuing in the context of a relatively strong but weakening uptrend in price. As always, be careful and safe. This is Corey Rosenblum with tonight's Theo video update for August 12th, 2021.